And welcome back once again, options traders. Well, during this time of high volatility, this is the end of June of 2022, I'm hearing that a lot of traders are turning to vertical spreads. And that makes perfect sense because vertical spreads are an incredibly powerful and versatile tool, and they are especially useful during markets with high volatility. However, what I have found is that a lot of traders miss an important characteristic of vertical spreads, and that is that you have two different paths to get to maximum gain. That's right, there are two different ways that you can get to the absolute maximum gain. And if you don't understand these characteristics, you might be making things a lot harder than necessary. And so if you understand these characteristics, it will help you to make better decisions as to which strikes to use. So what are these characteristics and how do you use them? Well, before we get started, as always, please be sure to click like and subscribe. It's very much appreciated and goes a long way into promoting the channel. So vertical spreads. The idea here is that vertical spreads have two main ways to achieve maximum gain. Number one, the stock price can push both options deep in the money prior to expiration. So maybe you've got the 100-105 vertical spread and the stock goes to 110 or 115 and it just keeps on chugging along. Yes, that vertical spread will eventually hit the difference in strikes or whatever the maximum gain happens to be, even though we haven't reached expiration. So that's the first way. The second way is that you can start your vertical spread with both options in the money and then just wait for time to pass. And because we know that is going to happen, right? Time has to pass. But the difference here is that we don't need the stock price to move. However, if the stock price does move, as long as it's in our favor, it's not going to hurt us. It's just that it's not required. Now, depending on your outlook and how aggressive you think this move is going to be, it could certainly make a difference whether you choose the first choice or the second. But what I have found is that many times the second method would be equally good, and especially when it's put up against your goals and your risk tolerances, you'll say, okay, well, that's certainly going to be a plenty good return for me. Well, why make things more difficult? Maybe we should start with both options in the money. So why is it that if you start with both options in the money that you only need time to pass? Well, let's go take a look at a vertical spread. We're going to look at the 100-105 call spread. It's a debit spread. So here is the bend at our long 100 strike. Here is the bend at the short 105. And we're going to assume that you paid $1.80 for it. So this would be your maximum loss. And if we get up to here at expiration, we've got to be above this 105 strike, we can hit the maximum gain. Now the maximum this spread could ever be worth is 5 points. That's the difference in strikes. But because we paid $1.80, the net that lands into our pocket as a profit would be $3.20. But now let's take a look at the current curve. This is what our risk graph looks like today, maybe with 30 days to expiration. So the first characteristic to know is that if we are on the left side of this risk graph, we have negative theta and positive gamma. And that means you are going to see this blue line as time passes start to get pushed lower and lower towards this black line. It will eventually bottom out down here. However, as time passes, if we're over on the right-hand side, you're going to see this blue line shift upwards. And that's because we're in the area of negative gamma and positive theta. So take a look. This blue line, let's say, has 30 days till expiration. So as time passes, we're going to see this blue line move up on this side and again down over here. So let's say some time passes, we might move from blue to red. Some more time passes, we're going to move up this way. More time goes by, and we just start slowly moving up this way. And then right at expiration, we're going to hit right up here into this black. This only occurs right on the expiration bell. But the key is, notice that we were appreciating over time. That's why we have positive theta over here. But take a look over on the left. Do you see how the line was sinking? And that's because you have positive gamma and negative theta. If the stock doesn't move fast enough, you're going to find that this spread is going to lose money, even though the stock might be moving higher. So when we looked at those two different conditions, the first one is maybe we bought this 100, 105 vertical spread with the stock way out here, maybe at 90 or 95. Why would we do that? Well, if you're in a high volatility environment, there is a good chance it could get up here. But notice that we need a long way to go before we're going to start seeing these lines get pushed towards this black prior to expiration. So if you are looking for a really fast, aggressive move, yeah, you might buy an out of the money option and sell an even further out of the money. But before you do that, make sure that you are expecting a fast, aggressive move. And of course, just because you're expecting it doesn't mean it's going to happen. You have to realize the odds are against you. But what if instead we bought the 100, 105 vertical spread with the stock up here at 105 or maybe a little higher? See, now we're operating in this portion of the risk graph and our spread's value is going to appreciate over time. But notice it's going to appreciate even if the stock just sits right here at 105 or if it also moves higher. That's not going to hurt us. In fact, it's going to just push us there even quicker. But it's not required. We just need the stock to really not fall below 105. So those are the two different ways to get to the maximum gain. And I thought it might be interesting to go take a look at these two different forces, the stock price moving and time passing in 3D. Sometimes it's a little hard to just visualize it when we look at just the stock price moving or just time moving. But let's go ahead and do both. And to do that, we need to jump over to Excel. All right, so now we're into Excel, and I've got our 100, 105 vertical spread. This is in 3D. So if you look at just this edge right here, that's kind of that lazy S current curve that we saw previously. So how do we read this? Well, we have stock prices along the horizontal, which is what we had before. But now we're also looking down into the page. And so we have 30 days till expiration, and then we're slowly watching time go by as we go back into the page. So now we're seeing both factors, or at least we can see both factors at once. On this scale, on the vertical, we have the value of the spread. And we can see the maximum value is right here at 5. And that's because it was the 100, 105 vertical spread. So the way that you want to look at this, and I've talked about this in other videos, is I think it's easier if you think of this as maybe an east-west street, and this is a north-south street. You could almost think of these as street numbers. So if you walk along to 120, and then if you move this way, in other words, we're allowing time to pass, maybe with 14 days to go, you would be standing somewhere around here. And if you look straight up above you, you're sitting right around here, and it's showing you the value of the spread at that intersection. So the thing that I want you to see is that in order to get to maximum gain, you either A, need the stock price to get way out here with time remaining. All right, so this is 30 days till expiration, but with the stock up at 140. And yes, you can push that spread to maximum gain. But take a look back here. See this little flange out here? That's also at 5. See how it's lining right up there at 5. And that happens right at 105. And that's because if the stock is here at 105 and we just allow time to pass, that's also going to push us into maximum gain. So let's do this. Let's go to 3D rotation, and I'm going to swing this around, and you can see this come into a better view. Right, there's a pretty good view of it. So right here at 105, there you can see we've pushed it to maximum gain, even though the stock hasn't really moved. We bought the 100, 105 vertical with the stock at 105. Now you can also see if it just so happens that the stock has moved to higher ground, 110, 115, that doesn't hurt us. We're still here at the maximum level. What really hurts is that if we have an out of the money spread and it doesn't move. So let's go back this way. See if we can find a better view of it. Maybe right around here. So now you can see that the stock has to really get moving up this way. We're still well below 5, and then right around in here we hit 5. So we would need maybe 30 days to expiration or just a little bit of time to pass. If the stock is way up here, we can hit maximum gain. But wouldn't it be nice to not need that much of an aggressive move? And even if it does happen, it's not going to hurt you. And we can do that by keeping the strikes in the money. Now, because that's a benefit, because there is a higher probability for you to hit this maximum gain much sooner, you will pay more for it. But this is why I said earlier that you have to have a goal in mind. If you're willing to pay 3 to make 2, and you can do it by using in-the-money spreads, why not? You can get to your maximum goal much faster, and even if the stock price moves in your favor. But if you're trying to take extra risk, yes, you are going to get a cheaper spread, but you had better see that stock make a very fast, aggressive move in order to push that into maximum gain. So I hope that gives you a different look and a different perspective at vertical spreads. It's again why a lot of times traders wonder why you would ever buy an in-the-money spread. And they say, I would never have considered that. And that's because in-the-money spreads sell at a discount, where out-of-the-money spreads trade at premiums. And so those are things we've talked about in the past, but here's just a good visual of it. So I hope it helps you to make better decisions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.